Greetings from Costa Rica. Today we're talking about avoiding double taxation and ensuring that you are structuring your Costa Rica investment correctly from a U.S. tax standpoint. My guest is Alex McGowin, a CPA with 12 years of experience. He's going to give us some great advice for structuring things correctly. Alex, are you ready?
Yeah, Matt, let's do it.
We have extremely important information for you about U.S. tax questions for investing in Costa Rica. I'm joined by Alex McGowin of McGowintax.com. Alex is a U.S. CPA with 12 years experience. He specializes in expats investing abroad. We're going to go over some critical questions to ensure that you are avoiding double taxation and preserving your capital gains tax treatment. Alex, thanks so much for joining us today. Your time is very valuable, and I appreciate you answering my questions.
Yeah, for sure. You almost sounded like an accountant there for a second, preserving.
Well, no, before we started recording, I've been writing down these little phrases because it's been new vocabulary. In the last 5 minutes we've spoken, I've already learned a lot of important stuff. So anyhow, really appreciate it today. Folks, if you want to get in touch with Alex, you can visit McGowintax.com. I assume all of your contact information is there, Alex?
Yeah, for sure. Yeah, you can. I have a lot of information on my website, McGowintax.com, and you can contact me through that. I also have a YouTube channel, which gives, it gets a little technical sometimes with the tax stuff. But yeah, I do a lot of tax related videos about, I guess.
Well, absolutely.
But yeah.
Now he's getting started on YouTube, and absolutely you can find his channel. McGowin Tax was very easy to come up with as well. Let's talk first and foremost, Alex, about the general picture for people considering buying property in Costa Rica. First, I get a lot of emails where people sort of just say, hey, I want to shelter some of my wealth, or I want to invest offshore as a way to avoid U.S. taxes. Is that at all possible? Can you structure things that way? Or is that just sort of a misconception when it comes to Costa Rica?
Yeah, I mean, Americans are in a unique situation in that we're basically the only country that taxes you based on your citizenship, and we have particularly, I guess, not difficult, but things you just need to know about foreign asset investments and how they have to be reported to the IRS. So in general, the goal is not so much to help your taxes. Is when you invest outside the U.S., the first step is to make sure you're not making it worse. Make sure you're filing the right forms and not paying unnecessary penalties, but also not being subject to double tax. Because when you start investing or moving outside the U.S., now that country, Costa Rica, they are going to have a claim on your income and the first claim. So the goal is really avoid unnecessary penalties and don't pay tax twice on the same income. Now, there are things you can do to potentially defer taxes, but I would say in general, it is a bit of a misconception that, okay, I'm going to set up this foreign company, foreign bank account, and all of a sudden, I don't have to pay taxes anymore in the U.S. That's necessarily true.
And in general, can you talk a little bit about the difference between Costa Rica, their financial reporting and their relationship with the U.S., and some of those financial paradises out there that, in the island nations or Switzerland, for example?
Yeah.
I always tell my clients, I believe Costa Rica has a very open sort of exchange of information with the United States government. What does that look like?
Yeah, I mean, really back in 2013, there was a big Swiss bank scandal with UBS, and that's where the IRS or the Treasury implemented what's called FATCA, the Foreign Account Tax Compliance Act. And I mean, this isn't the way they describe it, but essentially the IRS or the Treasury has blackmailed every other foreign country into providing information to the U.S. government on their U.S. account holders. So if Costa Rica, if you have a bank account, if you're a U.S. citizen, you have a bank account in Costa Rica, Costa Rican bank is required to report that information to the IRS. So they know about that information. And I say it's blackmail because the IRS basically said, you have to give us this information or you can't do any more business with the U.S. or we're going to tax you on your business with the U.S. So
Yeah.
right, you know, so they, and that's what triggers, there's reporting requirements once you start investing in, and you have bank accounts and things like that outside the US or in Costa Rica. And you have to be careful with, I mean, the reporting requirements have penalties associated with it, and the IRS knows about it, or at least can know about it through these intergovernmental exchanges.
Absolutely. And is it most often that the IRS can request information in the case that they're auditing a taxpayer in the US, or is it a case where foreign governments are constantly feeding information, sort of bulk data? Do you know how that works?
Yeah. So, I've kind of gone around in circles with this because it's not that transparent as to what actually goes on between the governments. But I used to think that more, I guess, to put it, because I don't like to just fear monger people and into, the IRS is going to get you if you don't report. But because right now, my clients, if you have a foreign bank account and you're not reporting it, I don't have any scenarios with clients like me where the IRS is finding out about it without going through an audit procedure and requesting that. Now, foreign banks technically do have to file a form with the IRS every year. So they know. They just haven't put in the procedures yet to automatically match the two. So right now there isn't any automatic like, hey, we know about this and you didn't report it and penalize you. That's not happening right now. But it is possible in the future. They have the information to do it.
Well, I was just going to mention here before we go too much further on that subject, I have a very positive opinion of all of the hardworking folks at the IRS and their hardworking, wonderful auditing departments and everything. And no, anyhow, the lack of transparency for sure. We don't want to be. I don't want my YouTube channel categorized differently at the end of this thing. But let's just jump right into some of the, retirees looking to invest in Costa Rica frequently come with a couple of ideas. Those are either purchasing through a 1031 exchange or their IRAs, self-directed or typical. First, let's cover 1031 exchanges. I just usually tell them, no, you cannot do a 1031 in order to buy foreign real estate. Is that 100% true?
No, I guess the rule with 1031 exchanges is, and the goal with 1031 exchange is to defer the income right on the sale of your property. So if you own a Costa Rican property, and we'll talk about the structuring later, but if let's say you own it directly or through a pass-through entity, and it's a rental property, so the IRS sees it as a business, if you sell that property, it's going to be taxable in the US, or you can defer that gain and roll it into the next property with this 1031 exchange. You can do that as long as it's a foreign to foreign exchange. So you can do a 1031 exchange from the sale of a Costa Rican property to another Costa Rican property, or actually it can even be in another country if you wanted to buy a Panamanian property or something like that. It just can't be in the US. You can't 1031 exchange a Costa Rican property for a US property, or vice versa, because I see it that way too. Somebody wants to sell a US property to purchase a Costa Rican property. That 1031 doesn't work. It has to be foreign to foreign, basically.
Well, that's very interesting that it could be Costa Rica to another country. We do get a lot of sellers here who very often they're selling because they don't want to be here anymore if they're US citizens.
Right.
And so, yeah, being able to then buy their property in Spain or Panama or that other destination that they're choosing next could certainly be an interesting way to avoid the tax implications from that income through a 1031. Very cool.
Yeah.
What about self-directed IRAs? I've had people, that want to purchase and avoid tax penalties from withdrawing funds from IRAs. Can they do that and buy a property in Costa Rica and avoid those stiff penalties for early withdrawals from their IRA?
Yeah, I mean, in general, you can. I mean, it's a good strategy and for diversification in some ways within an IRA, but there's very specific rules on how you do it. It's not that simple, I guess, as as most things with the IRS. But I mean, the main rules to think about is, first of all, you have to purchase the property with the IRA funds, and it has to be titled to your IRA. So,
Okay.
if you have 70 grand in your retirement account, but you have a bunch of cash, you can't outside of that, you can't purchase a property and contribute it to the IRA. It has to be purchased with the IRA funds. So you need to have enough capital in there to do it. And then secondly, you can't personally use that property. So it has to be an investment property. If you start personally using the asset, then it's no longer in that IRA, and that can cause problems. So those are the two main things.
Are you allowed to rent your own property if you own it and just literally like book it on Airbnb, or is even that disallowed through owning it with your IRA?
Yeah, no, I think as long as you can rent it to yourself, you just need to report. It would just need to be reported as income, I guess, in
Okay.
whatever way.
Very cool.
I'd want to look into that to make 100% sure there's nothing.
Okay.
nothing there, but I think that is possible. But you need
and I remember
you need to like set up a rental agreement. Like, so if the IRS
Okay.
had a question about it, it's not,
Yeah.
you just wouldn't. I mean, as with most of the things we're going to talk about, it's so much easier if you do it in advance. Like if you set up the rental agreement, as opposed to if you just start using the property and 3 years later you get audited, and it's like you're scrambling to try and find a rental agreement.
Yeah, totally. An explanation.
Yeah.
Oh, that's, I imagine, very typical advice that you're giving a lot of your clients is doing a lot of this stuff in advance.
Right.
So now let's talk about, we've just purchased a Costa Rica property. What forms do US citizens need to file? How long do they have to do it? What sort of thing do they need to do in order to get square with the IRS in reporting your Costa Rica investment? And how do people ensure that they're structuring everything to avoid double taxation and, messing things up with their US taxes?
Right. Yeah. I mean, and like I said, again, it's the goal in these cases is avoiding penalties and not being subject to double tax. That's the main goal. And so generally with a rental property, the goal is to have it be treated the same way it would be treated like if you invested in a U.S. rental property. So when you invest in a U.S. rental property, generally you're going to set up a limited liability company, and what happens is that defaults to a pass-through company. So if it's more than one owner, it's a partnership. If it's one owner, it's considered what's called disregarded. But either way, the concept is that income and expenses are flowing through to your personal return. When you sell the property later, it's a capital gain with a little nuance of depreciation being recaptured, but generally capital gain treatment. And capital gain is important because the rate is about half the ordinary income rate. So you get 15 to 20% versus as high as 37%. So it's a big difference. So what I find a lot, and this is a huge misconception with people, is that when you invest in somewhere like Costa Rica, you're going to generally want to do the same thing of owning it through a local limited liability company. The most common one is the SRL. So that provides limited liability protection to the owner and has some other benefits, I'm sure, locally. But when you set up a foreign LLC or an SRL, it has the opposite treatment of a U.S. LLC, in that the rule technically says if you have a foreign entity and it provides limited liability protection to all the owners, it defaults to a foreign corporation. So
Okay.
that generally is going to be a bad idea, especially for a rental property, because the rental income, and I mean, it's a little nuanced, but the basic idea is that no longer is the rental income and losses flowing through to your personal return, and losses don't carry forward. So, if you have a big investment in 1 year, getting your property ready for rental, and you have a big loss, you lose the benefit of that loss in a corporate scenario later if you sell it. Also, when you sell it later, it's going to be ordinary income. Now, it's a complicated way of getting to that answer, but that's the ultimate answer. As opposed to, if it's a flow through or a pass through company, you're getting that capital gain treatment. So to get there, that's a long way of me telling you how we get to the pass through treatment is what we want in general from a rental property. And to get there, you need to make a proactive election to treat it as that's filing a form 8832. And
Form 8832. Let's get that on the screen so people can see it.
Yep, it's called an entity classification election, and you need to file it within 75 days of setting up the company. But there is retroactive relief, so technically, you really just need to file it before your tax return due date for that year. So, like if you bought one right now on January 3rd of 2025. We really have until your 2025 U.S. tax return due date, which would be April or October of 26, to make that election. So it's not a huge rush. Like if you miss that 75 days, you're okay. If you go past that, it can cause some problems. But generally, so that's what we're going for: flow through treatment, proactive election.
Proactive election. So if you're watching and you have purchased property already, you can go back and proactively file form 8832, the entity classification, in order to get your flow through treatment. That's an accurate summary.
That is accurate. And then once you do that, with your U.S. tax return filing, there's a form 8858 that you have to file with your U.S. tax return that basically just shows your rental property gains and losses. Now, if it's not a rental property, you don't have that form because that's a business form. And if it's not a rental property, maybe we think about, you still probably want to do the flow through, because if you're planning on selling it, you want the capital gain, obviously. But there are situations where maybe it could make sense to have it in a corporation. But one other thing is that Costa Rica also has the SA, which is their incorporated form. That you are not allowed to make an election for that one to be a pass-through. So if you set up an SA, you're stuck with corporate treatment. So you want to do the SRL, make the election. That's the general advice. And like all things, talk to someone that has familiarity with this. Obviously, you can reach out to me, but before, so we can just make sure what is the right setup for you. But I'm just talking generally. That's what 95% of the time, that's how I'm setting these things up for people.
Absolutely. Well, and 100% of the time, I've been telling people, talk to your CPA back in the US to ensure that you're doing what you need to do. Now I'll be able to say, watch this video where Alex, spoke about this exact subject.
Because what happens a lot though is, especially if it's somebody's first time investing outside the US, they have an accountant they've been working with forever, and they're usually excellent accountants. There's a good relationship there, and it doesn't make sense to stop working with that person just because you've now invested in a Costa Rican rental property that may be a small aspect of your overall financial picture, And
Absolutely.
So a lot of times what I do is work with their existing accountant just on the international piece. That way, because I know what it's like. I have clients I've worked with for a long time. It's tough switching accountants, and having to build a whole new relationship and all that. So it's not it's not always necessary, I guess is what I'm saying.
No, totally. It's one of those last professions that has, really, the high importance of those relationships, where you see people still having their offices in little teeny towns in Indiana. The accountant is on the square and everybody with the business in the community goes there.
Right.
Especially a lot of
We've lost the
retirees.
green visors. We've lost the green visors.
Yeah, totally. Yeah, they're like processing punch cards as you come in. Yeah, but no, I mean for sure. I know that you can see that phenomenon affect people, like with attorneys in Costa Rica. People who have developed relationships, and then the attorney's experience doesn't extend to real estate. I'm sure it's the same phenomenon in accounting, because their focus is keeping an Indiana business tax legal and running. Yeah,
Right.
what do they know about Costa Rica and rental income, et cetera?
Right.
I want to ask you, a lot of clients, would your advice in sort of that structuring your purchase as a corporation and electing it to be a pass-through entity, does that change at all if someone, are you imagining that rental properties are only a source of income? If people are, purchasing properties that are actually going to accrue losses, most likely, would your advice change at all?
No, it actually would make it more likely. It would make it more beneficial to do the pass through. And there's things,
Perfect.
because in general, if you have a rental property, it's the same rule in the U.S. as with a foreign property. If it's a flow through or pass through, the losses will flow up to your personal return, but they get locked out. They get limited. So you can't use that necessarily against your ordinary income. Like if you have a day job, you can't use that loss against your ordinary income. It gets locked out until you have income later. But one thing I do with a lot of people is there is rules under the real estate professional rules. So like, for example, if you have a spouse that's a non-working spouse, it's very hard to claim real estate professional if you have an employment job, because you have to be able to prove you spend more time managing the real estate than you do with your day
Uh-huh.
job, which is hard to justify in a lot of cases. But if you have a non-working spouse, you can put him or her on as your real estate professional, and then you have to be diligent about logging your hours. But I mean, managing real estate is time consuming.
Mm-hmm.
And so it's not that hard to get to the 750-hour requirement, and then you can use those losses against your ordinary income. So like if your spouse has W-2 income, you're managing the rental, you can now use those losses against your spouse's W-2 income, which when you start factoring in depreciation, so I mean, we talked about earlier, I said it's kind of a misconception that you can't save taxes. You definitely can. There's things you can do, but step one is don't be taxed more.
Correct. So, but in that case of your spouse being able to pass through their losses, that was only on sort of a U.S. activity. It wasn't on foreign property ownership or a foreign corporation. Or yes, you could do that.
Yeah, you could do it with the foreign property as long as you make this pass-through election. So if you
Perfect. So
don't,
yeah, your spouse is losing money as a foreign property owner,
exactly.
and because it's a loss that you're taking as their spouse, you can count it against your regular income.
Yeah, exactly.
Interesting, man. Yeah, I could speak with you for hours because the questions I have abound. Absolutely, I'll suggest that if my clients out there are looking to get these questions answered, get on Alex's website, McGowinTax.com. He knows all this stuff. Frankly, I'm just coming into this and getting more acquainted with some of the concepts, etc. Really appreciate you joining me, Alex. Absolutely, you've been a great contributor here. If you want to get in touch with me, folks, you can contact me directly by emailing matt@costaricamatt.com. Be sure to subscribe send me any questions. You can put them in the comments. Thanks very much for joining us today. We'll be back live next Friday. Actually, I take that back. Next Friday is a huge birthday in our family. Jonas will be turning 10 years old, so I will certainly not be live. Anyway, we'll get something out there Friday. Have a good one, folks. Thanks very much for joining us.